We are going to introduce you to our company, Unlimited Footwear Corporation. Unlimited Footwear Corporation is a corporation that manufactures, produces, and distributes the sales of a consumer durable product. The interest of the stockholder is very important to us, and therefore we are going to give you an insight about our company. We have Anik, our president, myself as a vice president of finance, Leah, Vice President of Marketing, Albert Aguilar, Vice President of HR, Christina Flores, Vice President of Operations, and Jonas, Vice President of Management. We have all been an important asset to the company, and we have worked together the past 4 years and have conducted a very successful business along the way.
So I'm going to present our performance targets compared to our actual results for years 5 and 6 for return on assets, return on equity, market share, stock price, unit production cost, and total net income. For year 5, our target for ROA was 5% and our actual result was 16.02%. We expected ROA to increase due to most of our production being moved to our Nystock plant. We had a total of 9 lines producing, 6 in Nystock and 3 in America. For year 6, our target for return on assets was 6.5% and our actual was 21.92%. For return on equity, for year 5, our target was 6.5% and actual was 22.35%. For year 6, our target for return on equity was 8% and actual was 31.77%. We were able to increase our ROA by so much by issuing bonds and repurchasing stock. For our market share, our target for year 5, we had a sales goal of 7,000 units. Our actual market share though was 17.88%. And for year 6, our sales goal was 10,000 units, but our actual market share was 18.76%. Luckily, after poor sales during year 4, where we had multiple stockouts, we were able to regain momentum and increase our market share. For year 5, our target for stock price was $1.40 and our actual was $2.40. For year 6, our target for stock price was $1.60 and our actual was $4.53. We were able to increase our stock price by selling stock and by buying back CDs. For year 5, our target for unit production cost was $3.70 and our actual was $3.62. For year 6, our target for unit production cost was $3.30 and our actual was $3.55. For year 5, we were able to meet our goal by more than we anticipated. And for year 6, we were just a little bit off. However, it did increase from year 5 to 6. We were able to decrease UPC using our low-cost, affordable product strategy. Our target for net income for year 5 was $800,000 and our actual was $2,083,000. For year 6, our target for net income was $1,020,000 and our actual was $3,675,000. Fortunately, we were able to increase net income by much more than anticipated. We didn't perform too well the previous year due to multiple stockouts, but luckily we managed to regain momentum and started producing and selling much better.
Okay, in the following section we will go over the individual strategies that were executed in years 5 and 6. We'll also discuss how effective they were in enhancing Unlimited Footwear's performance. Later we will cover any mistakes or problems with these strategies and if there was any specific change in our strategy. Our major strategy was to keep our products cost low in order to sell at a lower price than our competitors. This was accomplished by a number of methods. First and foremost, we only raised certain costs by inflation. Okay, although there were slight differences, some aspects that stayed close to this method were commission rates, salary levels, and advertising spending. Commission rates were inflated every quarter by inflation for year 5. In year 6, we really needed to increase the profit and only raise the commission by inflation in 2 quarters. In year 6, we really needed to increase profits and only raise the commission by inflation in quarters 2 and 4. To compensate for this commission reduction and encourage our salespeople to stay, we raised salaries slightly. Our overall strategy was very effective in enhancing Unlimited Footwear's performance. We did have to alter this strategy to some extent, but remained within a decent range of our original forecasts. There was one area which did not conform to our overall strategy of raising by inflation. Advertising was one of the areas where we realized raising by inflation would not fulfill the needs of our production. Unlimited Footwear was producing thousands more products than we could sell. We realized this quickly and rose advertising a significant amount. We also continued to raise it, especially in high seasons, which were quarters 2 and quarters 4. Price was an area which did not conform to our standard, and in reality was determined by the market and our competition. We did not have an advantage of best quality because our mission was to be the low-cost competitor. We expected others in the market to raise their prices, but when they didn't, we had to compensate for that. We knew that we had to have the lowest prices in the market, so we substituted from other areas such as commission and our number of salespeople. We also used a different strategy for unit sales. In order to compute future unit sales, we did a regression analysis with Excel. This regression took into consideration a couple of different variables. The factors we used to compute were previous sales levels and seasonality indexes. Our low market share affected this forecast and dramatically in year 6.
Total R&D spending. For years 5 and 6, our actual R&D spending was lower compared to our planned spending. This was the case because we decided that we would only sell up to product model 5. Since our strategy involves selling affordable shoes, we felt that we did not need to invest heavily in R&D in order to get the latest model as soon as possible. Our aim was to be only one model away from our nearest competitors, and we achieved that goal. There is a big gap between our actual and planned spending in year 6 because by that time we were already at the model we needed, so we decided not to spend any more than necessary. Product model produced. Because of our strategy, we were able to meet our planned production of Model 4 in year 5 and Model 5 in year 6. Once we met our goals, we decided to no longer add any additional investments into R&D. Going forward, we will invest more if necessary. Our cost savings level attained matched our planned outcome for both years 5 and 6. This was feasible due to our strategy of low production costs and limiting expenses. Even though our production costs were higher in year 6 compared to the other teams, we were still able to attain the lowest unit production cost. This gave us a good income to sales ratio. Our total beginning inventory in year 5 was off over 100 units compared to our plan because we were not able to sell enough. This was due to the negative effects of our emergency bank loan. It actually got even worse in year 6, where our beginning inventory was at 1,639 compared to our planned 637. This was due to many factors, including not having enough salespeople and perhaps not pricing our products correctly. The market competition was also fierce as it was in subsequent years. This is the reason why we chose not to put any weighing factors in market share. However, we do plan on combating this by having more salespeople and pricing our products more effectively. Our storage expense for American 2 in year 5 was also off due to the unexpected consequences of our emergency bank loan. We incurred more storage expenses because we had more inventory left over that needed to be stored. It also went up dramatically in year 6 because of the increased inventory we had. We plan on minimizing this by not producing as much until we can lower our inventory to an acceptable range. Total storage expenses in iStock. We had the same reasons why our storage expenses increased in iStock because of our increased leftover inventory. They were not as much compared to America 2. This was due to the fact that we shipped out most of our products out of nice stock into other market areas. Active production in lines first shift. For years 5 and 6, Unlimited Footwear maintained the use of 9 lines. This number of lines was sufficient based on our needs. We did plan on adding one more line in America 2 for year 6 and quarters 3 and 4, but decided against doing so because we were already producing enough products and our inventory was high. This saved us money by not activating, but we also did not make as much income. Active production line second shift. Unlimited Footwear did not decide to use a second shift because we felt using overtime was more economical. We actually never used a second shift ever since the company was founded, and we do not have any plans of doing so in the future. Production output America 2. Our production output was well within our plan in year 5. This was due to the fact that we were able to produce efficiently according to the market needs. In year 6, we were lower because the demand for our product was lower and we had high levels of inventory. We reacted by choosing not to produce too much so that our inventory levels would go down.
I'm going to speak about our company's financial plan. Start with bank loan. Unlimited Footwear do not want to acquire any bank loans throughout year 5 and year 6 unless it's necessary to do so. Our company don't want to worry about high interest payment or a high interest rate that we have to pay. However, we were resulted in the bank loan in year 5 quarter 2 because our expenses were high and we invested heavily in CD and we purchased many shares of stock. However, we pay off our bank loan immediately, so we did not have to pay for any interest payment. Initially, we decided to invest $2 million for every quarter in time CD for year 5 and year 6 when we have sufficient cash flow and can take advantage of the interest earnings. We also take into the account interest rate. So whenever we see the opportunity of high interest rate, we will invest in time CD. After we pay for the bank loan in year 5 quarter 3, we will purchase almost 1 million shares of stock to increase our company's ROE. In year 6, we plan to issue 3 million bonds to expand our company on advertising, salespeople, productions, and R&D. However, we only issue 1 million due to a low cash flow and low net income. Our goal for year 5 is to increase our net income. In year 6, our company's main focus is to repurchase stock and pay out dividend to boost confidence to our company's shareholder and to the public stockholder in order to increase our stock value. We also plan to invest in time CD, and in actual, we did invested $500,000 in CD for each quarter. Further, we did not want to issue any stocks, and we only go into repurchase about 5 million stock in year 6.
For our UPC, we are consistently one of the lowest in our peer from our peer companies. For our stock price, the results we result in 3rd place because we improved in the last year. In our 6th year, we improved every single quarter, and our net income as well also improved. Overall, our performance targets only got better as from year 5 and year 6. For year 6, our peer comparisons resulted with unit per cost being one of our main factors. We resulted in finishing second. Like year 5, we expected this one to be one of our lowest performance targets. We also had the 3rd biggest market share. Our market share in year 6 improved every quarter, but company 4 throughout the game had the best market share, and it was difficult to catch up to them, as well as for company 4. For ROA and ROE, we came in third, fourth, and fifth. Our total net income we ended up finishing last in total net income, and this was a result of having having the lowest prices, and even though we did sell more in year 6, our low prices did not allow us to make as much income as the other team.
For the income statement, for the net sales, the actual net sales to customer were lower than expected, mainly due to advanced model that our competitors were offering during year 5 and year 6. Company 4 has been consistently produced one model ahead of what we produced and in the coming year, Unlimited Footwear aim to increase net sales by investing more money in research and development. By doing so, we will be able to produce advanced models and stay ahead of the competitors. For the administrative and general expenses, the range of the storage expense was 126.03. This is due to the lower actual sale amount. Since there was a large amount of inventory left unsold, our company has to store them in a storage unit that eventually lead to a higher storage expense. And for other income and other expenses, the rents from other income and other expense came from CD and bonds interest. The amount of CD interest was much lower because our company did not have as much cash as we had expected in our 2 years plan. Therefore, we were not able to invest as much as we had hoped. For net profit and loss after tax, our company actual net profit after tax was 48.92%, less than what we forecasted. As mentioned above, the factor that led to this included lower net sale to customer, higher advertising expenses, higher storage costs, and lower CD and higher bond interest. For the cash flow variance, first of all, I'll talk about operation. Under operation received, there were several large variance between the actual and pro forma numbers. Account collected, CD interest, subsidiary dividends received, interest paid, production costs, and taxes paid. And I'll be talking about the investment. Under the investment receipts and expenditure, the only variance came from CD purchase and CD mature. As we mentioned previously, we did not invest as much as into CD as we had planned. And for the financing, the large variance from our company financing expenditure in year 6 was due to stock repurchased, which was 330.66 more than the pro forma amount. We repurchased as large amount of our company stocks in order to increase our stock price, and this strategy proved to be helpful in achieving our goal.